Everybody, today is Monday the 9th of August 2010. This is Brian Shannon from alphatrends.net. Let's take a look at this S&P 500. As we know, this market has been in this nice uptrend here since reaching this little shakeout low back in late June, early July, and from there we've seen the pattern of higher highs and higher lows emerge. Well, the last week or so we've been stuck right at that June high, which was 113.20. In fact, today we got up to 113.18 intraday, and what we're really seeing here is still a lot of uncertainty. We look at the weekly time frame. We still have until we really close above that high here from June. We still have a pattern of lower highs and lower lows, and the question becomes: is this rally just the next what's going to establish a lower high here and before the next leg lower? Nobody knows that answer, but you have to be impressed with the resilience of the market, the way it is shaking off the bad news and climbing the wall of worry. Friday we had the jobs report, which sent the market down to a level that we were looking at for support, which was 111.80. It rallied from there, couldn't get going all the way, and instead it dropped down to the next level that we were looking for support, and that was the 111 area. So what does that tell us? It says that, well, the market is really reactive to news headlines. It's still trading technically. That, in other words, the levels that we're identifying as potential support areas are holding. What's going to be of concern is if those levels do in fact give up and fail to hold. So going forward, tomorrow we have the Federal Reserve meeting. That's obviously a big catalyst that could come in and do damage to this trend. And here we see this beautiful trend line from that July low. Well, there's a saying, just like support and resistance, the more times tested, the more likely it is to fail. So we have the danger that this trend line would break. Breaking the trend line doesn't mean it will be fatal to this market, but 111 I think is going to be the important level for this week to watch. If we can maintain above that, then I think that we're either going to continue to correct sideways in here and just some quiet summer trading, or we're going to be breaking past this 113.20 level, and I think a push above that level would quickly see this market rally up towards about the 115 area. So there's a lot of uncertainty, and you can look at all this news and say, Friday afternoon I saw a lot of chatter about how the market was going to open lower on Monday because of the Hewlett-Packard news. Well, the market really didn't care about Hewlett-Packard, HPQ. The market didn't really care about Hewlett-Packard so much, or chose not to focus on that, or it just said, realistically look at it and say, here's something that had a lot of people really in a panic, and the market shrugged it off. So we have to listen to price action first and foremost. It's only price that's going to pay us always, and that's a broken record there that just said that. Today's volume was light, but we were up 0.5%. So if you lost money being short, it doesn't matter what the volume is. But the fact is, we're hammering away at this resistance. Will this market be able to push up through that with the Fed maybe as a catalyst? Or sometimes what we see happen prior to an event like the Fed is that we'll see the market may in fact break out in the morning and build a nice enough cushion. Let's say it got up to 113.80 or so, and then it might sell off on the Fed, but then hold up above this support. That's a scenario that may happen. Obviously, anything can happen, but you want to be prepared for just about anything. And the market really, again, is at a critical level here. There's really, it wouldn't make sense to make a big bet in either direction until we have further price confirmation. We're above the 200-day moving average. We've held above there 6 days in a row on a closing basis now. So that's got a lot of shorts nervous, I think. And you look at the financials hold up nicely as well. They were kind of flirting with that 200-day moving average, but if we drill down a little bit, we see here in the daily time frame, we did briefly get above 115 and closed above there that day. Last week I was saying that the financials needed to hold above 1450 for us to still have a potential at a bigger breakout. We were focused previously on this, or we're observing this inverted head and shoulders pattern. I said just because it breaks the neckline doesn't mean you purchase. It means that you drill down to shorter term time frames and manage risk. Well, since then we've had these lower highs and lower lows, and we're starting to recover right at that 5-day moving average. So for the financials, 1450 will continue to be the important level to watch this week. We break that, then we could be heading back down towards the low end of this range. If, however, this market can get probably back up above 15 15 or so, then I think you're going to see a what might be a pretty good short squeeze rally here. So either way, it's still a lot of uncertainty in this market. So keep your share size reasonable and be quick to hit the sidelines when the market tells you that you're wrong.